Okay, ladies and gentlemen, we're moving to our final session of the evening, which you'll have seen in your program is billed as a fireside chat. The more observant amongst you might have noticed there isn't actually a fire in here for us to sit beside. Apparently some health and safety people thought it wouldn't be such a good idea to burn half the habitat centre down. So treat it as a figurative fire, one that is warming our toes and warming the cockles of our hearts, that kind of thing. Anyway, the theme of it is renewable energy financing. We can enthuse all we like about the prospects of clean energy, but unless we can finance it, it's never going to take off. So as our distinguished guests slowly depart the scene, I'm going to welcome on three excellent fireside companions to discuss this. I think they're lurking in the wings at the moment. Please welcome onto the stage, we have Mr. Vijay Nirmal, Program Manager of US Clean Energy Finance. We have Mr. Manish Chourasia, who's the Managing Director of Tata Cleantech Capital Limited. And we have Mr. Tirkar, who's Principal of Asia Pacific Responsibility Investments. And last and absolutely not least, we have our moderator, Mr. Vivek Subramanian, who's co-founder and CEO of Fourth Partner Energy. So Vivek, I'm going to hand over to you to start our conversation. Thank you.
A very good evening, everyone. So I have two very unenviable tasks. One, to follow up a fantastic panel that happened. And as you can imagine, that's something I absolutely, and I'm sure I speak for all my colleagues here, we may not be able to keep up to. And that's not in our control. But what is in our control, and the other unenviable task I have, is to make sure that all of you all are in time for your drinks. And I'm sure you're very concerned that we should wrap up this session on time. And I won't keep that happening for too long and make sure that we wrap up fairly quickly. Thank you for making it. My name is Vivek Subramanian. I'm the founder of a firm called Fourth Partner Energy. We are India's largest commercial and industrial focused solar player. Essentially, as most of you all know, solar can be deployed both on-site and off-site. And this panel is going to talk about the kind of deployment that is done focused on these C&I clients or commercial industrial clients, both on-site and off-site, and talk about some of the operating level challenges. If I look back at the panel that was, and it was fascinating, where Dr. Mathur, you all talked about how countries have to get together, coordinate, and make sure they achieve an objective of 2050. And it was scary to hear some of the numbers being talked about and the probabilities being assessed to the success of this initiative that needs to happen through. This is quite a microcosm, right? This is a completely different subset of it all. Here at an operating level, we wanted to highlight and talk about a space which otherwise has been proven to be quite a success. So if there is one space in the renewable energy sector, which is now well established to be a compelling case going forward, it would be this particular segment, implementing solar solutions for C&I clients. It's a space where the cost reduction that is being offered to your industrial clients is compelling. Typically, clients save between 30 to 70% in their price of power when they deploy a solar power generating system. So the economics is extremely viable. In the last few years, this industry has grown at around 70% year on year. We're talking of a CAGR of 70%, which is fabulous. I'm sure a lot of other industries would give their right hand to be where this space was. It is also a space, as was being discussed in the earlier panel, which has a very bright future, given that a lot of industrial capacity is going to be built out in the next few years. So some of our clients, for example, we serve Coke, Pepsi, Ferrero, Mars, Ultratech Cements, all of them have now only scratched the surface of what they believe is the overall potential that they would want to deploy in India in the next 15, 20 years. And as you can imagine, for all new capacities coming up, they go hand in hand with solar implementation to back up the power as well. And so this sort of macroeconomic situation is extremely viable for a lot of financing to flow in. And it did for a good 2-3 years or 3-4 years as the story was taking off. Roughly to put the industry size in context, on-site rooftop solar plus off-site supplied to commercial industrial is around 3.5 gigawatts, but around 3.5 gigawatts, around 7 odd gigawatts that has been implemented in this space till date. Potentially in the next 3 to 4 years could actually at least go up by 5 times more. That is the extent of potential that this space has. And a lot of that dependent on 2 or 3 key things coming together. The industry coming together, technology working, operations working, the policies being favorable, but most of all, financing coming into the foray. And today's panel is all about talking from a financing perspective, and I have alongside with me a fascinating set of gentlemen who have watched the space, who have financed in the space, who have backed several stories, projects, and companies in the space with the objective that it will grow and become a much larger part of their portfolio going forward. But where we stand today in this space, and I just want to draw out the context for all of you, is this year in this space probably we'll be very, I think most of the players in the industry like us will be happy if the industry grows at around 10 or 20% as against a historical 70 odd percent. So its industries come up against, of course, an economic slowdown, of course a slowdown in the demand from our clients as well, but most of all, a lot of regulatory challenges, consequently financing itself being slowed down. Of course, the NBFC crisis, what's happening with the banks in India have all contributed to this. But financing in this sector has seen a sort of slowdown, and I wanted to talk about some of the operating level challenges that are faced at an industry. So just to draw the context again, summarizing that to the previous panel, we need to do a lot as the world coming together to make the stories happen, as was brought out by Dr. Mathur in his panel. But at our individual operating level, in the commercial industrial space, which was what you would thought the sunshine sector within the solar sector, there is a lot that was happening for it that is starting to pull back. Let's find out from our panel what's happening in this space. A quick introduction, gentlemen. Samir, you want to start with introducing yourself and the firm, please.
Yeah. Hi, I'm Samir Tirkar. I'm part of Responsibility Investments, which is a Swiss development investor. We manage close to $3.5 billion in development-focused investments, out of which close to $1 billion is focused on climate finance initiatives. We have recently raised around $200 million focused on CNI and energy access. And we have been kind of investing in the space for nearly 3 or 4 years. So that's a quick background that you have.
Thanks, Samir.
Manish. Good evening, everyone. I am Managing Director of Tata Cleantech Capital. Tata Cleantech Capital is the first private sector green investment bank in the world. In fact, all the other initiatives are with public funds. This is the only company which is a green bank under the private initiative. We are promoted by Tata Group and the IFC Washington. We are about 6 years old company, but our main activities have started in the last 3-4 years, when we have funded more than 200 projects in the clean tech sector. In fact, we have a line from Green Climate Fund, which is dedicated to solar rooftop, which is a 100 million line. So that's a brief introduction about us.
How much have you all invested so far, Manish?
We would have lent about 10,000 crores in this sector. Our outstanding book is around 5,600.
That's great. Excellent. Thank you. Vijay?
Yeah, thanks, Vivek. Thanks to the Fourth Partner team and the WSDS organizers for inviting us to this session. I am Vijay Nirmal, and I am part of Climate Policy Initiative. We manage a program called US-India Clean Energy Finance. It's a joint initiative between Ministry of New and Renewable Energy Finance and US foundations with an objective to enable debt financing into the distributed solar sector. So far, the facility has been operational for around 3 years. We provide the initial risk capital of around $100,000 to $150,000 to help the developers become investment ready and then approach lenders for debt financing. So we've partnered with lenders like Tata Cleantech Responsibility on one hand, and we've supported several distributed solar developers in India, and it's been fairly successful so far. Happy to share my learnings during the discussion.
Excellent. Thank you, Vijay. I think for somebody like you who gets a bird's eye view of how to bring lenders into this, you'll be able to take on some of our questions. So I think, gentlemen, just to quickly get to some of the obvious questions, we've talked about the opportunity, as most lenders do. Let's talk about the risks that you all perceive in this sector. Manish, you want to start. What are the obvious risks that you see when you lend to projects in the renewable energy sector, more so to the CNI space?
the key risk is enforceability of contracts. So if you see this sector, it is characterized by very high capital investments. But after that, the operating cost is much lower. So because the capital investments are so high, essentially the lender has to take a call for 10, 15 years. The loan cannot be repaid in 5, 6 years. It can be repaid only in 10 to 15 years. So given this reality, the important thing is that there has to be a predictable revenue. And that revenue is a function of the contracts, various contracts. First is there's an off-taker. Let's talk about CNI. So the off-taker should be strong enough to ensure that he makes payment for his electricity in time. Apart from this, there's an evacuation network for which the developer and off-taker has a contract with a discom. So that contract has to be firm. The renewable is essentially an infirm energy. So it produces only when the resource is there, and sometimes there is no production. The consumer has its own consuming pattern. So there are times when the power which is produced cannot be consumed at the same time. So there is a need to bank the power. Now if that policy keeps changing, then obviously there will be issue in terms of the revenue. So this is one contract. The other contract is that if you are using an evacuation network, then obviously you have to pay for that evacuation network. So it has to be known with certainty what is the cost of that network. If the cost of that network keeps changing, then the contract may not be viable in long term. So essentially, I think the key thing in the success of this whole financing is the enforceability of contracts. That is something which is also not that difficult to follow, provided each parties keep their commitment. So that is number one. And number two is we have to see very closely the financial profile of the off-taker. So we have to be very sure that because we are lending for 10 to 15 years, the off-taker should be in an industry and his position within the industry should be such that he will himself remain viable for such a long time. So these are the two key factors which are very important for us. Third factor is important, but there, as we have discussed a few times in the earlier forum also, a lot of progress has happened, which is technology. So fortunately, the technology has kept pace. And today, there are systems to ensure good generation, to track those generations, to ensure that the panels can be cleaned, they can be monitored from a distance. So that aspect is something which, while it is important, but we have more confidence in that. The other factor, which is mainly the enforceability of contract and the off-taker credit risk, that is something which we are more concerned about.
Sure. Manish, if I may just push you on that. When you talk about contract enforceability, as a lender, where have you seen the greater challenge? From the off-taker or from the contracts associated with the distribution company or other government entities to whom there are these charges that are applicable? Where is the greater risk that you perceive as the lender?
So, I can say that in a very straightforward way that our key concern has been the certainty of policies.
Policy certainty, uncertainty.
Essentially, when it comes to the off-taker, because we have a lot of data, we have the rating of the off-taker, we get access to their financials, we know the industry. It is possible to predict the profile of the payment track record of that off-taker with more certainty. The key issue comes when which is the policy uncertainty. So the issue has been that if you see the Indian scenario, if you see the solar rooftop, then the net metering policies have not been very stable. Secondly, the banking policies when it comes to the open access have not been very stable. Sometimes there's the issue of some ad hoc charges. So these can play a very significant role in the viability of the project. So that has been our bigger concern than the profile of the off-taker, so to say.
Sure. Samir, similar views?
Yes, so the way I see it is, I'll classify in two other segments. The same thing. The way I see it is, the key risk is sector risk and transaction risk. Right?
Sorry,
sector risk and transaction risk. See,
okay.
The off-taker, the developer, the internal contracts, that is a transaction risk.
Yeah.
We can evaluate, we can kind of build safeguards, build financial covenants, everything to kind of tell against that. The sector risk is the larger risk where even international lenders are more worried about, and it is not just linked to how CNI performs. They see it as an entire country where there is stability of policies. You can't roll back, you put a policy, then roll it back, then implement something else. even it's for a related sector, it's for utility scale, kind of impacts the entire renewable energy space, how people see that. So I think sector risk for us is, I think, a much larger risk than compared to a transaction risk. Transaction risk, lenders are equipped to kind of manage, deal, mitigate transaction risk. Sector risk is something that we really cannot manage or digest very easily.
Why don't I come to the regulatory or the sector risk in just a following question. Samir, just to push you on the other point that was made. So for you to assess the sector, the players of in the sector the way it is, how do you as an international lender or your organization as an international lender, how are you all looking at the players in this sector? You think there is an amount of maturity, the ecosystem is fairly well developed, material availability, component quality, any views on all of these?
In terms of material, in terms of technology and everything, we see people, if you work with the right set of developers, they are doing great work, they are implementing great quality projects, and you have to work with them. One disadvantage of the sector growing so fast and it being so lucrative was everybody kind of jumped into it.
Right.
But you have to now kind of be selective in kind of people you want to work with, because there was so much money to be made that everybody wanted to be a CNI developer.
Right.
There was capital available to an extent for, leaving the last 12 months aside, there was, for a small segment, there was capital available. People were just going around shopping for PPAs, implementing it, quality was being cut because the developers did not have the wherewithal to implement high quality projects. So that was a challenge which now I feel is getting weeded out. Now capital itself is becoming a constraint. So only the serious, slightly larger players with better quality projects are sustaining, are getting contracts. So one aspect is being taken care of. From a regulatory policy angle, I think for in the last 12, 18 months, in fact, it's been the most negative contributor to the entire segment. Be it safeguard duties for panels, be it states rolling back or kind of questioning PPAs which have been signed in the past, or PPAs rolling back, net metering kind of a thing. That is something that we are still grappling with. And right now we might still take the risk, but it's like, you are investing despite these hurdles and not because the entire regulatory framework is supportive of it.
Right. So players, so long as you back the right players, it could still work and make a story happen, but it is still the overall regulations that keep you awake or your organization awake in this context. Vijay, just to pull you in as well, you have, your organization has the unique advantage of being, having access to the people in the government, being initiated by the government itself, but also to other very large international institutions who are setting standards on what this industry should shape as, if nothing else. How do you view these key issues that are coming up, which is across states, regulatory flip-flop between net metering to gross metering to other charges being imposed or banking charges being revised and so on and so forth? How do you view these regulatory flip-flops, and how do you as an organization, how are you all working to help mitigate these issues?
Yeah, so just before addressing the regulatory uncertainty, maybe I'll touch base on the risks that Manish and Samir have talked about. So Manish and Samir have highlighted the actual risks involved in the project. Maybe I'll touch upon the perceived risk which is in the segment as of now. We all know that the rooftop C&I or the rooftop solar installation currently is at 5 gigawatt, while the year-on-year growth has been tremendous, which is 70 to 80%, but compared to the actual, the growth required to meet the target of 40 gigawatt, it's far, far low compared to that. So what are the reasons? So one, is it an issue with the supply side of financing? I don't think so, because we have several lines of credit already lined up, be it the World Bank SBI, the IREDA KFW, the GCF Tata Cleantech. So that's not an issue. Policy uncertainty, yes, we'll address that. But I also think that there is an issue with market saturation, not the whole of the rooftop solar sector, but specifically the rooftop C&I A-rated off-taker segment. Most of the RESCO developers currently are focusing on A-rated off-taker segment, which is, in my view, more or less saturated. And there's a huge potential within the MSME segment, which is not at all explored, or it's largely untapped as of now. The reason behind this is the perceived lack of creditworthiness of the MSMEs in the market. And the main reason is that they don't have adequate payment track record to provide comfort to the lenders that they are actually creditworthy. And as Manish said, credit rating is something that they would look for prior to or doing a due diligence on the loan. But of these MSMEs, almost 90% of the MSMEs in India don't have a formal credit rating. So I think it's more important to shift from a credit rating perspective to a credit assessment perspective. I mean, while the shift actually takes time, in the interim, it's important to actually devise certain risk mitigation instruments, at least to create a demonstration effect that MSME entities are actually not, they're actually creditworthy and that the risk is actually perceived and it's not actual. So I wanted to highlight that the MSME segment is largely unexplored and it's important for all rescos to get into the
What
sector.
risk mitigation mechanisms can you think of?
Like
like an insurance underwriting for a first stop loss.
Right. So we are working closely with the Ministry of New and Renewable Energy and the World Bank in designing a credit guarantee mechanism for driving uptake in the rooftop C&I segment within the MSMEs. And the idea is to provide a first loss comfort to the banks and also provide a partial credit guarantee. It could be around 50%. So the idea is to only create a demonstration effect that it's only a perceived risk of default and not an actual default. So once the lenders start coming into this segment or funding rescos who have offtake arrangements with these MSMEs, then we are of the view that the market would open up and meeting the 40 gigawatt target wouldn't be much of an issue, because one of the studies quoted that MSME segment itself has a potential of almost 20 gigawatt for rooftop solar installations.
Absolutely, I couldn't agree more.
I'll just add something to it. In the MSME segment, there's a huge potential to use the alternate data. So while credit rating, as Vijay rightly said, or some of the other formal data like financial statements may not be available, but still now a lot of analysis can be done through data like GST returns, through the PF returns, and that is quite a reliable data. The challenge in the rooftop sector specifically is, of course, it's not uniform across all the companies, but then it is still a sectoral risk that ultimately you are using the rooftop of the same person. So if that guy doesn't pay you, you really can't supply power somewhere else. What probably you can do in open access, though sometimes it is not easy in open access also because you have to take permission for changing the offtake and so on and so forth. So you have nowhere else to go. If he doesn't pay you for the power, you can't supply that power somewhere else. So inherently, the segment is quite risky. I'm talking about the OPEX model. But at the same time, I agree with Vijay that there will be a segment which can be financed and a scalable model can be built through a proper financial structuring and using the alternate data.
Sure, Manish. No, I think in this context, a couple of points from my end. I think for sure, as the industry matures, the ecosystem matures, the ability to redeploy assets that are moved from one location to a secondary sale, for example, is all things that are coming through in the industry, very much maturing in that direction. On the SME side, the more penetration there is, the price of power for SMEs is higher than it is for HT consumers, as we all know. So it's the value proposition is even larger. And financing or the OPEX model is a greater value add as well, unlike to a Coke or Pepsi. So definitely for both of these reasons, the opening up of the SME sector should be a massive initiative, and you as lenders should push through. But I think some initiatives that allow for risk mitigation should also allow comfort for all. Vijay, I'm going to get back to the regulatory side,
sure.
Just to get a sense.
Yeah,
basically.
on that point, I agree with Sameer's point saying that stability of the policy is more important than the efficacy of the policy. So if the policy is stable, then the investors would get a chance to at least price that risk within the capital pricing and then decide whether to enter the market or not. But if there is a fluctuation or flip-flop within the policy framework, then it's a major setback for the investors. While there are issues around net metering, fluctuation to gross metering, and imposition of additional charges, be it the Maharashtra intent to put in the grid support charges, etc. There's a positive side of the phase 2 program of the rooftop solar implementation, where the DISCOMs are proposed to be incentivized for encouraging rooftop solar within their areas, and we see this phase 2 program to have a lot of potential to unlock rooftop solar installations within the country. This is for the rooftop solar. On the open access, I agree that there have been a lot of restrictions on banking as well as the tariff or the price at which the unused bank power is being procured by the DISCOM. But on the other hand, there is a positive thrust towards promoting the group captive power projects. May not be the third-party PPAs, but promoting group captive power projects is a win-win situation for everyone. In fact, even for the lenders, they feel comfortable in funding group GCPP projects because the end consumer has a stake in that, has an ownership of 26% in it. So the risk of default comes down to a much larger extent compared to a third-party PPAs. So while there are negatives in the policy uncertainty, there are some positives in terms of, say, the phase 2 rooftop solar or the promotion of GCPP projects.
Sure. Enough to keep us on the edge and keep us interested. I think that's, I think, the overall summary. Gentlemen, just to a final set of questions, and I'll then throw open the questions to the floor. Just for the benefit of the audience, again, what is your outlook for the sector in the next 6 months, 12 months? What is the kind of commitments in capital that you are looking to make into the solar sector and more specifically in the C&I space? Samir, you want to just give an outlook of the firm. What is it that you all are looking at? So if there's a developer somewhere who wants to approach responsibility, they will have some
our
idea.
stance, especially for India in general, will be cautiously optimistic. So like I said, we've just raised a fund which is going to focus on C&I to a large extent. In Asia and Africa and India, I think we'll have the largest allocation from that. So we are cautiously optimistic on the distributed space, be it rooftop, be it C&I. We continue to deploy. Our target for next year would be anywhere between $40–50 million is what we're targeting to deploy in the next 6 to 12 months in the country, in the space. Other thing that we are trying to do is kind of help people, kind of the Indian players expand regionally into Southeast Asia. I think that is also a focus area for us. MSME is slightly a step far for us right now because we really don't have the bandwidth to kind of analyze so many off-takers in a single proposal. We'll have to work out a different mechanism, be it a credit guarantee mechanism, something for us to get really interested and start deploying capital in the MSME segment. Right now, our focus for the next 6 to 12 months would be the large off-takers, be it open access or rooftop.
Sure. And this would be primarily debt capital, Samir?
Yes. Right now, debt is ready. The idea is to kind of meet players, understand and see what other kind of capital is required and see whether we can then set up a new, but that's a long-term process. But for the next 12 months, it's going to be debt with the idea that we bring in more products to kind of help the entire climate market grow.
While on this, if I can just push you one more step on this, from what you all see, especially given your international presence, do you see sufficient equity capital coming into the space? Because as it is always the most important, starting right at the top, as they say, from a waterfall perspective. Do you all see sufficient equity capital coming into this sector?
I see sufficient interest in players to invest equity. And now, whether they'd actually go ahead and close a transaction or not is dependent on all the risks that we kind of debated. But there is a tremendous amount of interest from international investors to provide capital to this segment.
That's good. Good to hear. Manish, your views?
So we are optimistic, in spite of all the issues, because India is a huge market. And not only in this sector, in a lot of other sectors, you've had winners and you've had losers. And in fact, everything else in India also moves in a similar way. Why we are optimistic is the fact that, one, as I told you, India is a huge market. Secondly, it also depends upon, because it's a huge market, there's a segment of the market which is good. And it depends upon the lender, how you use the data, how you analyze the company, how you structure a loan.
Sure.
So if I can give you an example, a project A may not be viable at, say, 80% debt, but could be very viable at 55% debt.
Correct.
So as long as we have a right kind of partnership with the equity holders, I think we can scale up the segment significantly. Both in the structured space and also in the SME space. And as I told you, we already have a line of 100 million from Green Climate Fund. And to that, we are going to add our 100 million line. And we hope to use this as soon as possible.
Excellent. Excellent. Vijay, what is your view on the extent of capital that you think you all are going to help through for India in the next 12 months?
So our contribution is actually in the form of risk capital. But as I said, while MSME remains the focus area over the next 4 to 5 years, it's also important to deepen the corporate bond market in India because it's important to recycle the traditional bank debt that's flowing into the corporates. So our work would also focus over the next 2 years on deepening the corporate bond market or what needs to be done, what interventions needs to be taken up to actually initiate the securitization process, what needs to be done in terms of aggregation of projects, what standardization levels need to be brought in. So our focus area would be more on deepening the bond market and also bringing in more capital, institutional capital into the sector.
Sure. More longer term patient capital
Patient
that will allow
capital,
for
yes.
the industry to prosper. Yes. All good, excellent. Questions from the audience? Yes, sir. You have a question for Manish, I presume.
Hi, good evening. This question is for Vijay. Two questions. One, you earlier talked about the group captive projects. So my question was, while in theory, group captive projects, of course, for lenders also, since you're dealing with off-takers, which are corporate off-takers and which have much better credit quality, you would tend to prefer those. But from a DISCOM's perspective, unless you've separated the content and carriage, what is in it for the DISCOM to really promote group captive projects? We have seen this increasingly. Initially, there is euphoria, and thereafter, once they realize that they are letting go of good customers, there is always a pushback. So that is question one. Question two is on MSME part, where you talked about the perceived risk. Is there any data to suggest that the risk associated with MSME lending, specifically in rooftop, is actually a perceived risk or not a real risk? Why I'm saying this? Because you can't see this in isolation in a vacuum. If you're also talking of policy instability, net metering or gross metering, additional surcharges and so on and so forth, it is not just the intent issue, it is also the capacity issue. If I'm a small customer and then over and above this, these charges are added, I simply do not have the capacity to pay, right? So how do we then say that it is a perceived risk and it is not a real risk? Because then if I'm dealing with a bigger developer or a bigger institution, at least I'm not worried about him not being able to respond to these changes using his own balance sheet. But in case of an MSME, he'll find it increasingly difficult. So these two questions for you. Thank you.
Yeah. So I'll first take the GCPP. Even I was kind of wondering as to why DISCOMs are promoting the GCPP and what's the difference between GCPP and the third-party PPAs. DISCOM is losing either ways. So what I understood is that DISCOMs are able to meet part of their renewable purchase obligations through the purchase of surplus energy being sold from the GCPP projects. So the banked power, which is unused, which is by the end of the month or the end of the year, which is being procured by the DISCOM, is factored into the RPO compliance of that DISCOM, which is kind of an incentive for the DISCOM to promote GCPP compared to any other third-party open access projects. Second question on the perceived risk versus actual risk, that still needs to be demonstrated, because the scale that we are talking of is MSMEs are like 64, 65 million MSMEs in the market. The primary survey that we did and through the feedback or information that we got from the rescos who approached these MSMEs is that most of them have not defaulted on their electricity bills, like Manish was highlighting on the alternative data to do a credit assessment. Most of them have not defaulted on their current bills, on their telephone bills, or on the basic necessity, or they don't have bank debt. So there's no track record to prove that they've defaulted on a bank debt. And in the absence of bank debt, then there's no credit rating, which again limits their access to financing from the banks. So your point on whether it's proven or not, it's still not demonstrated whether it's a perceived risk, but the feedback that we got from the market is that these guys, especially the MSMEs, whose energy costs account to around 45 to 50% of their P&L or the expenditure, they've not defaulted on their electricity bill so far and would continue to pay, given that it's a discount to the grid tariff. That's the only case.
Okay, just a couple of points added to that. I think most of what Vijay is saying I agree with. I think from the, so get to the first one on this. So if you take, for example, the extent of permissions that are being given for such projects in the entire scheme of what is demand, take the state of Uttar Pradesh, the entire CNI, entire demand put together is around 10,000 megawatts, of which around 350 megawatt is the kind of permission given for open access. So it's obviously, it is going to remain fringe, because the only incentive, as you rightly highlighted, is built around submitting a certain RPO obligation being met through the center and getting some incentive hopefully built in as a compensation from the center to the state. It is not mainstream, it cannot be till the horse and carriage are as united as they are. On the SME side, I think to go back to the point Manish made, clearly the structure of the contract has to be different. It cannot be a same 70-30. It can't be the same rules of the game that were extended to the larger caps. That will go on for the mid caps, small caps, and for the SMEs for sure. You all have to find some better risk mitigation mechanisms. But I think this aspect, which is that that we just touched upon, energy is dearer to them, the price of power at an LT connection is much higher, and the fact that financing will be extremely useful would mean that this should be one of the first bills that they clear. Do they have the balance sheet ability? Probably, obviously not much, but that's where good structuring should come into play, I think. Other questions, please. Yes, sir. Probably one last after this.
Hello, this side Anuj Gupta. Solar is the future of North India, but penetration is not deep. Why?
Roughly the points we said, sir. While there is policy issue, while there is the demand is great, the economics are great, the policy issues are in place, but fundamentally you're talking to financiers. They are telling you why.
If the energy deficit is still there, then what will be the future of electrical vehicles in India? We will ignite the petrol generator, diesel generator, CNG, then how will we charge electrical vehicle?
I agree with your view that if we are going to be energy deficient, then the EV story may not take off as much as we think it will. But I'm sure there are other points that we should consider that will allow for this story to come through.
Solar
I'll
is
just add
still.
one point. See, one thing which could change is the storage becoming more competitive and viable. So as was told in the last forum, the storage cost over the last decade has reduced by 85%. And it is actually reducing by about 10 to 15% per annum, in fact more than that. So very soon you might have a stage where you don't actually require net metering because you can store that power and use it at a different time. So while we have discussed policy uncertainty, world over, because the discoms, they are losing good customers, it's a kind of a disruption for everyone. But what is important to note and what is likely to be the game changer is the development in technology. So once the storage becomes cheaper, already it's, as I told you, it's coming down by almost 15% per annum. There will be a stage when storage plus generation, the cost of that would be quite competitive. Maybe 3, 4, 5 rupees, which will definitely lead to a disruption, and where you will see a significant scalable growth, exponential growth.
Can I add in that little bit? Solar is not the favorite or the first love of the bankers in India, and still discoms don't like.
That's right, sir. They do, but yes, fundamentally, as we just discussed, we are eating into their business, so it is bound to happen. In fact, one of the big issues, I think, in such discussions is that it need not be an us versus them. I mean, we need the discom alongside us, not against us.
Discoms are in confusion. We are not eating them. Solars will enhancing their capabilities, but they are in confusion.
That's right. That's right. I think contractually also, we as developers would love a scenario where we have the discom also as a co-signatory to the same power purchase agreement. So if I'm signing up a contract with a large industrial consumer, or even a SME for that matter, and if I had the discom also as a co-signatory to that PPA, and also sharing in the commercial value of that contract, we are happy to make that happen. The one bill that all of us make sure that we clear at the earliest is our electricity bill, because we know that the discom will switch off the power supply. So if my solar bill gets risk mitigated by the supply of even normal electricity power from the grid, it would make a very unique combination for risk mitigation. And it needs to stop becoming an us versus them game, and we need to be partnering together to do this.
Absolutely.
Anyway, one last question before I myself head to the bar and ask all of you all to head there as well. Yes, sir. Sir.
Yeah, why we are so shy of nuclear? We hardly use around 10%, and other parts of the Europe already more than 80%.
Gentlemen, do you all finance nuclear?
No, not really. I'm not kind of equipped to answer that question. Honestly, it's a technology that most lenders will not understand. Most commercial lenders will not understand. It is a very policy dependent kind of a technology. Financing for that, it's not done at a commercial scale where commercial banks will have capability to lend to that. It's a very government initiative which needs to be financed by the government, taking a call on the
More
technology.
sovereign level involvement
Yes.
possible.
Yeah,
Manish?
so in fact, there are countries who have used nuclear very effectively. What comes to my mind is France. But nuclear, one overarching concern is the accidents and nuclear liability. So that is something which has happened in the past, and those accidents are very severe accidents. I guess it is that concern which is one of the major impediments.
Manish, do you all consider nuclear as clean or not clean?
No, we don't finance nuclear.
Okay.
So
Just check. I mean, the definitions change country to country, so just checking.
yeah, so there's also issue of public opinion here.
Accidents are happening
Yeah.
in other parts of the world also.
Sir,
you're
probably
right.
a question we should,
Yeah,
it's more a
this
policy
is,
level, I think.
This is
decision
policy
to
level,
make.
public opinion, it's more on that level. We are, I guess, much smaller fishes.
On that note, I'd like to end this wonderful session. Thank you very much to the panelists. Your insights were extremely useful, and I'm looking forward to this industry maturing even more. Thank you, everyone.